So, Keith, you're seeing a lot of choppiness ahead. Let's talk first about what choppiness means, how long this choppiness is going to last, and where do you see the real impact? Because I know you're also bullish on small caps. We've seen a lot of downturns in the Russell 2000. That's supposed to be the reopening index. Where does that choppiness, I guess, end?
Well, first, Frank, I think, on Friday we saw a volatility shock. And what happens because there's uncertainty around on this new variant, and it's going to remain uncertain in the near term, that creates a very headline-driven market with a lot of back and forth. But I will say, Frank, we are encouraged by what we're seeing here the last couple of days from an investor sentiment perspective. Markets are all about where things come in relative to expectations. And we are now moving to more of an oversold market, and investor expectations have been reset. For example, this morning, we just saw the AAII retail sentiment gauge showing the highest amount of bearishness in about a year. So, and when we tie that together with this VIX spike that we saw on Friday, where 1 year forward markets tend to be up or have been up 18 out of 19 times when we've seen volatilities spike up more than 40%. I think as you look forward 6 to 12 months, we should still have a constructive view of the overall market.
All right, so you're saying you have a 6 to 12-month outlook being constructive, but choppiness, end of year into the first quarter, where do we see that playing out?
I think it's over the next few weeks, but I still think there's a decent chance that we'll see Santa Claus this year because we've reset those expectations so much that I think the market's actually starting to be set up for positive surprises. Unlike if you think about before this variant hit, the market had just climbed almost in a V-shaped recovery of about 9% since early October. We saw the average allocation by newsletters to the market at 70% or 73% recommending an equity allocation. That's down to 18%. So yes, choppy near term, headline driven, but ultimately we think that that we'll get through this. Listen, Frank, think about the last 2 years of this market. We've gone through this pandemic, and even though we've had the Delta variant, other concerns, profits are at all-time highs, markets were at all-time highs, and consumers and corporations have adjusted. So I think we should still have some optimism with this market.
Keith, great point. But you know what else is at all-time high? Inflation. I know you're looking at different areas where you can kind of get a hedge on inflation. One of the areas you're looking at are actually REITs. You see it as a combo of a tech and growth play and also as a defensive play. You got to explain that one.
No, it's an interesting sector. It has all those characteristics that you mentioned. It has kind of defensive play that has an above-average dividend yield. It has a reflation side of it with the real estate side, the commercial real estate. But what's underappreciated is a lot of the REIT index today has had a transformation towards a digital economy. So things like warehouses, distribution centers, and also the cell phone towers. So we think that's a good kind of balanced play where we think you're going to have this back and forth that will offer some stability in the market.
Really interesting stuff there. Any other areas we were really looking at right now? I mean, obviously, there's so much just change in the market. Anything else really quick that you're looking at you think investors should keep their eye on in addition to REITs?
Yeah, I think since we have more choppiness, a bit of a barbell approach makes sense. So technology, but I also think that now small caps will start trading around a PE of about 14, which is near a multi-year low, is also attractive as we move past the other side of this variant to go ahead with that versus some of these more defensive plays. So I think that's an attractive entry point after this 10% correction we've seen.
All right, I want to ask you one more question before we let you go. Let's get technical.
Sure.
Let's get technical. Don't always do that on WEX. We're going to do it this morning. You have 4,500 to 4,550 as the support level for the S&P. It's now below its 50-day moving average. What do the technical indicators say to you?
Yeah, on a short-term basis, that's a bit of a negative. But I will say, as I look at the risk-reward, if we get back to the old highs, that's about 10% upside. We have really strong support around 4,300, which is closer to that 200-day moving average. And the amount of stocks that are below that 50-day moving average right now in the market is about 30%. Historically, over the last year, that's been actually a good place to start legging back into the market because we're a bit oversold. So I think, again, the risk reward has improved. Doesn't mean we can't see more downside, but I think as we look through even towards the end of this month, I think that this is an opportunity for investors to move in. But expect, again, that volatility to continue near term.